So the VIX exploded to the upside. It's been retreating from the peak, aka the market bottom, and it's been trending down lower and lower and lower and lower, but it never really got into its normal range. What is a normal range? It's the range between 12 and 25. It never really got there. And when you see this level of $25, it was a resistance all the way back. I mean, you can go back in the chart all you want, but I marked these points right here where it's been a resistance, and you could expect it. I mean, it was a support here when the VIX went down. You would expect it to be support. And again, here it is. It just refused to trend down. It refused to go down. And that should have been a clear warning to everybody. Why is the market making all-time highs, at least in the Qs, in a lot of the tech names and other names, and beyond a V recovery? Why didn't the VIX fall down to its normal range? Why didn't the VIX just collapse in coordination with the market explosion to the upside? That should have been by itself a warning to everybody. But here's the thing that I want you to take a look at. A lot of people assumed, if you were in the V recovery camp, your assumption was that the VIX is just going to explode the upside, collapse all the way down to its normal range. But that doesn't usually happen when you have a big breakout in the VIX. Let me show you an example here. The closest example we can go back to is the 2008-2009 financial crisis. And here's what happened. You have your big primary move, and then it cools down. It cools down, it goes back to normal range. And the second aftershock right there before it goes down again. Another big move. Here we go. 2016. Big explosion to the upside. Primary move. It cools down. Secondary move right there before it goes down to normal ranges. So we can assume that this move will repeat history and have this big primary move going down, cooling off, and another secondary move at minimum before we go down and trend down again. So this is what the VIX chart looks like this morning on a weekly perspective. If we see any sell down to the downside, we'll be buying the VIX in its proxies, of course, because I believe that there's another bigger secondary move, bigger than this candle alone. The other thing I want you to pay attention to, back in the 2009 crisis, the VIX went down to its normal range. It retreated all the way back to its normal range before the secondary move. Here, in the move that we have right now, it never got back to the range, to the normal range. And that keeps me up at night a little bit, that the market recovery isn't really as good as it's being sold out to people. There is a possibility that we can make a higher high than the primary leg. But for now, we're just going to go with what history taught us, that this is a big primary move accompanied with another smaller but yet huge secondary move before we retreat and take it from there. Now, what do you do with this information? Let me show you a trade that I did during the market hours on Friday. And I just want you to get the mentality here of how to conduct a trade like an artist, where you reduce your risk, and in this case, win-win, lose-win. That's what I'm looking for here. Whether the trade goes my way or against me, I still collect money. And that's my motto in life. Win-win, lose-win. How did I do that? I opened a trade on the UVXY, that's a proxy for the VIX, around 7 o'clock. And here's a tweet that I tweeted so you can look at the time. I bought the 45 volatility level, and I paid $330 for that contract. I later on sold a higher leg of 55, so I was opening a dead spread, but I sold that leg for $340, which means that I got paid. I turned a dead spread into a credit spread. I had 2-in-1, meaning that if the VIX closes the week under 45, my 45 leg and my 55 leg that I sold will expire worthless. Yet I'm going to collect $10. Lucky for me. However, if we surpass 45 and 55, I can get up to $1,000 gain plus the $10 that I collected. Here's what happened though. 10 minutes, just 10 lousy minutes after I sold the 55 leg for $340, it exploded to the upside and it became worth $335 just 10 minutes after the trade. In that scenario, in an ideal scenario, and nobody gets timing right, but if I did, hypothetically, I would have collected the difference between $735 and the $330 I paid for the 45 leg for a difference of $405. Meaning, in this scenario, hypothetically, the worst case scenario is I get to collect $405. And the best case scenario is I get to collect $1,405. How do you like that? Win-win, lose-win. But because of the 10 lousy minutes that I rushed, I get to have $10 in the worst case scenario. I get paid $10 to conduct a trade. And in the best case scenario, I'm getting $1,010. But how do you like getting paid to conduct trades? This is what a guy like me does every week. I hunt for these opportunities, and I can teach you how to do it. All you have to do is share, like, and subscribe, and I will show you how to conduct these trades in the future. But this is the idea here. Reduction of risk to the maximum level possible. I'm getting paid to conduct a trade. I'm not buying an out-of-money call or put option that expires in the same week and watching the ticker on the chart minute by minute, stressing like I'm watching a horse race. I'm not updating and refreshing the futures at night, stressing about my trade. I'm stress-free because I got paid to conduct the trade. Win-win, lose-win. That's our motto. If you like this video, like, share, subscribe, follow me on Twitter, and I'll see you later.